The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 28th of November. We've got a guest with us this week. We've got Alastair Stewart. So welcome, Jeremy, and welcome, Alastair. Good to have you both here.
Hi, good to be here.
We've got a lot to talk about, and obviously Alastair's here to mainly discuss the budget. But before we get into that, Jeremy, what did you want to say across the macro landscape, and is there anything else apart from the budget to think about?
I think it really is all about the budget this week, isn't it? Because while the Americans were having a bit of a holiday to give thanks for their good fortune with displays of overindulgence for Thanksgiving, we were celebrating our government who've been overindulging on our behalf. And
They have.
We've been learning how they intend to split the bill among us so we can pay for it. Rachel Reeves delivered her second budget, which is what everyone's really been talking about and expecting, feels like, for about the last 6 months. And while she made it clear she wasn't going to be mansplained by anyone, not least the likes of us, I think that's probably what was going to be the meat and potatoes of our discussion today. I think it was RBC that described the budget as jam today and pain tomorrow. And politically, to give her credit, I think she's probably learnt a few lessons from last year's disaster. But the spending measures were front-end loaded, and the tax increases and the revenue generating measures will take effect throughout the Parliament. So later, as Simon French said in the Times, it was a budget that was not overtly inflationary, but it was more of a sticking plaster on a weeping wound.
Feels about right, yeah. I suppose from my perspective, there were no horrendous surprises. Everything was pretty much in line. I think, and in some ways that's very depressing that we've had a budget like this that everybody's kind of okay with, because we've been feeling the pain for so many months, with the speculation and rumours and selective leaks of ideas to sort of see what happens. All of that's been going on, and that's been painful in itself. That just worries business, it worries industry, it worries consumers. People in all walks of life delay spending decisions, delay investment because they just don't know what's going to happen. And that's been very painful. So I suppose the good news is that there's no new pain, but the real pain, I think, is the pain that we've been experiencing for the last several months. But I guess there was one particular area of the budget which always gathers a huge amount of attention, and that's the house building space. So it's great to have you here, Alastair. What was your take on the budget? What would you see as the key takeaways?
Well, my overview is that from a housing market and a house building perspective, it was only moderately negative rather than apocalyptic. Actually, if you look back to Q1 of this year, the housing market had actually picked up quite reasonably. All of the house builders reported that in their earlier trading updates.
Okay.
But following the Easter holidays, speculation started to mount about property taxes in particular, fueled by more kite flying from Treasury officials than was seen in the finale of Mary Poppins. There wasn't a day that went by without some horrendous tax being mooted, mainly driven by wishful think tanks relayed to Treasury officials. And if they didn't rule it out, that day's news headlines was Treasury officials are seriously looking at X, Y, or Z taxes. And then among journalists, it got into a bit of a feeding frenzy. Started off really with The Guardian in August suggesting that stamp duty was going to be totally overhauled and replaced by charges on homes that were upwards of $500,000. Then you had mansion tax coming into the mix. Landlords were going to be charged national insurance on their personal rental income. Helped on the more positive side, potentially for the house builders. There was going to be a return of Help to Buy, etc., etc. And you can see from the data from the RICS, for instance, it wasn't so much prices falling. Prices were fairly resilient. It's just there wasn't much actually changing hands. The number of buyer inquiries and vendor instructions both fell really quite badly, really in autumn in particular. Every single house builder's trading statement included reference to the B word. So it had been very distractive. But in the event, there was very little at all. There was no removal of stamp duty. It's too much of a golden goose to the Treasury. But they did go about a quarter of a way on the alternative taxation mansion taxes. It was on £2 million properties, 2,500 per annum. And then above 5 million, there was a higher rate. Probably the only people affected by that would be asset rich, but cash poor Labour supporters in Islington, where you don't get much change for £2 million, but they've probably had VAT and school fees to contend with. So the mansion tax will only raise £400 million. I reckon it'll be less than that once you've paid to track down this 1% of households affected.
Yeah.
But the real impact on super prime or even prime London properties was actually last year's non-doms taxation, which really did send quite a few people to the exit doors.
Yeah.
The lettings side, it didn't actually come through national insurance as originally suggested, but it was 2% on income tax. And that's for personal holdings, not corporate. That will be just another nail in the coffin for the amateur buy-to-let market. They've been selling out in any case. That's been pushing up rents even as affordability ceilings get squeezed. But it may well pave the way even more for build-to-rent. People such as Granger and Watkin Jones, it was a positive there. And while we're on the corporate side, Help to Buy 2.0 just never materialized. I'd stuck my neck out for a long time before saying, if it were to be coming, why are the two best politically connected house builders, Barrett Redrow and Persimmon, introducing their own privately funded versions of this support package for first-time buyers? There were other bits and pieces in there, but overall, the benefit for the wider housing market is, economically at least, relatively uninflationary aspect of the budget, but also it's just this lifting of the gloom, what I referred to as Treasury-induced coma that had affected the whole housing market. And as a result, I reckon Q1 of next year, you could get a real relief rally, all that pent-up demand. So long and the short of it, it's probably good for the mainstream house builders.
So you'd be expecting a pickup in housing transactions, secondary housing market transactions in Q1 next year?
In Q1, I think we're too late to start the ball rolling. Now people are already going to Christmas parties. So I think dry January will involve a lot of people running around looking at house builders' sites. And it could be quite good.
Got it. Okay, yeah. And as you say, I mean, you looking back on calendar 2025, almost half of the year has been dominated in terms of the housing market by people worrying about this budget.
Absolutely.
Which is horrendous, really, if you think about it. But as you say, even last year's budget, which was pretty painful for large areas of the house building market, despite that, Q1 of this year was not too bad. So if you roll that forward, yeah, absolutely. So there could be a lot to look forward to in the sector for Q1 of 2026.
And the important thing looking to next year, after a potentially strong Q1, is for the Chancellor to muzzle hers or his officials and just stop them talking.
Yes, we don't want a rerun of this last 6 or 8 months of pain and worry. Absolutely right. But as you say, a big part of the benefit seems to have been the bond market reaction and the fact that it feels like long-term rates aren't going through the roof. So, Jeremy, did you have a view on that, whether the budget is inflationary or disinflationary? Because it feels like it's been relatively well received.
I think most people agree that as a result of this budget, it makes it more likely that the Bank of England will be able to lower policy rates by one turn before Christmas this year and a couple of turns probably in the first 3-6 months of next year. So rates are going down, but I think the acid test is how the bond yields react to those moves. What we'd like to see is for that 10-year to come down, and they did come down this week, but there's always more than one thing going on. And the benchmark 10-year US Treasury yield also came down. So for a global investor looking at the UK, I would argue it's pretty mute and things are unchanged. I mean, it's no worse. Our spread more on premium, inflation, built-in inflation premium, borrowing premium, one of the tragedies of the UK market, is persisting. And I don't think there's anything here long term that's really going to change that view. But I think just looking at it as the domestic market dynamics, I'm sure Alastair's right. One of the features of having the government sector, the public sector, such a dominant feature, such a large proportion of the economy, this so-called fiscal dominance means that everything else dances to their tune, and to have the private economy, the private sector on hold for the majority of the year waiting to see what they do is just one of the consequences of that. And I think there is nothing in this budget that really, there's some tinkering at the edges. We're promised that we're only going to get one fiscal event a year. We used to get two. So I guess we should be grateful for small mercies, or whatever the saying is. I think overall, it's okay. She's learned a few things from the missteps she took last year. This was a budget for her backbenchers. It might be too late to save herself. It might be a suicide note for her political career, but I think it will extend the life of the Prime Minister and the administration. And I think that's the principal objective here.
Yeah, so lots to learn. And yeah, interesting the point that, 10-year yields might be coming down, but perhaps they would have come down anyway. So we can't read too much into that. And maybe she just got a bit lucky. But yeah, it feels like, a lot of lessons to be learned from the process and the way that it's been managed. And it seems like Rachel Reeves did learn some lessons from last year. So if she can learn some lessons again from this year, and if she's in the seat next year, and as long as there's only one budget, then maybe there's a few things to look forward to.
Yeah, but she certainly doesn't want it to be mansplained to people like
Sorry,
us.
You're right. I'll be careful. Absolutely right. Great. Okay. Thank you very much both for that. And then, as always, Jeremy, we look ahead to next week. What have we got coming up in terms of macro data on the next 7 days?
We've got some ISM data, both on manufacturing and services from the US, which should signal a pretty robust macro economy for the US still. We've got some inflation numbers from the Euro area for November, which are going to be broadly unchanged. But I think looking forward, it's going to be about Trump and the White House becoming increasingly desperate to keep the majority in Congress in the impending midterm elections, which aren't until October next year. But I think it's what they're going to start focusing on much more seriously as we move into 2026. So I think that will require a mandatory abolition of not just recessions, but market setbacks. So I think we're going to get a juiced financial economy, and I think we'll get that exercise moving into full motion in Q1 of next year. So as we discussed last week, what are the telltale signs of liquidity coming in or leaving the market? There's a lot of headlines around the collapse of the Bitcoin price in recent weeks, and it has come down a long way. But since we last spoke, it's up 13%, of which you won't see any headlines in the FT or Bloomberg about. But I think that's telling you something. And I think it's telling you that the worry and that the extended liquidity issues from the shutdown and other factors of recent weeks, that's now passed. Doesn't mean we're immediately going to move into a round of quantitative easing, but I think that is the next expectation for the market. And the global backdrop for rates and for liquidity is positive. And if that is going on in the dollar economy and dollar markets, that rising tide lifts all boats, including the UK. So to back up what Alastair was saying about Q1 of next year, I think, for sterling assets generally, whether it's houses or stocks and shares, I think it's probably going to be quite good.
Yeah, I think lots to look forward to for Q1. If the Americans can help improve the global economy for their own political purposes, that's fine. We'll take that. And as Alastair, as you've said, if the budgetary impact on the housing market for Q1 26 is anything like the impact we had in Q1 of this year, a lot to look forward to there as well. So that's great. Good stuff. Phew, budget done. Thank you very much, Alastair, for your contribution. Great to have you here again.
You're welcome.
And Jeremy, we'll chat this time next week about something which is not budget related.
Hopefully.
Talk to you then. Okay.
Bye.
Thanks a lot.
Brought to you by Progressive Equity.